All right, welcome to The Explainer. Today we are diving straight into a forensically underwritten capital allocation opportunity. If you're an institutional investor out there hunting for a highly structured, risk-off asset in a sector with absolutely massive demand, well, you're going to want to pay attention to this one. We're unpacking the Winelands student estate, and we're going to be looking at the whole thing strictly through the lens of risk mitigation and capital protection strategies.
Okay, let's dive into this, because this number right here is the headline. We're looking at a mathematically solvent downside protection buffer of over 122 million rand. For us as institutional allocators, this is where the conversation actually starts, right? Before we even dream about upside or yield, we have to talk about exactly how your capital is shielded from loss. This massive cushion completely rewires the risk profile of this development, and we're going to break down exactly how it functions.
But first, let's ground these numbers in reality. The Winelands student estate isn't just your standard student block. It's practically a 1,000-bed sovereign microcity, strategically dropped right into the high-demand Stellenbosch commuter corridor. We are talking about an immense, fully loaded CapEx project of 834.9 million rand. And to execute smoothly at that kind of scale, the financial mechanics have to be absolutely flawless. So let's get into how this capital is structured.
So here's our roadmap. We'll cover the institutional capital ask, that bulletproof downside risk protection, the milestone-gated capital deployment, the sovereign micro-city moat, and finally, priority returns and exit. Let's unpack logically how this is a defensible, risk-off asset and definitely not a speculative play. Starting off with Section 1, the institutional capital ask and its ring-fenced SPV structure. Now, what's really interesting about this slide is how the capital stack is structured within this highly protected, ring-fenced, special-purpose vehicle. Notice the 55% senior debt portion there, 440 million rand. It's a very standard, highly defensible loan-to-cost framework, but the critical takeaway is that this senior debt only enters the picture after all pre-construction and entitlement risks are completely discharged. It's paired with a 15% sponsor GP equity stake of about 155 million rand, which leaves that remaining 30% for our primary focus.
And that remaining portion is the sponsor ask. We're looking at 240 million rand in preferred equity, which represents exactly 28.7% of the fully loaded total CapEx. What's absolutely vital to understand here is that this 240 million ask is structurally insulated. The SPV is a clean, ring-fenced vehicle. It's completely isolated from the parent engineering firm's balance sheet, meaning it's entirely insulated from any outside operational liabilities.
Moving right along to Section 2, the real meat of the matter, bulletproof downside risk protection. For institutional allocators, this is arguably the most critical part of the entire underwriting process. I want you to think of these mitigations as physical shields. Take a standard development. A macroeconomic inflation shock can be absolutely devastating, right? But here, it gets completely absorbed by a 58.7 million rand uncapitalized sponsor efficiency buffer. Worried about a nasty 12-month zoning delay? The model maintains a positive 56.2 million rand cash reserve even under that kind of immense stress test. Plus, the sponsor's deferred fees and equity essentially act as a massive 154.9 million rand first loss absorption blanket, taking the hit long before your investor equity is ever touched. When you stack those layers up, it totals 122.6 million rand, which translates to a 19.2% base cost protection cushion. This dual-layer buffer gives you bulletproof downside protection. If there's an acute market shock, the internal margin simply compresses. Bottom line, the project stays securely solvent, without ever requiring secondary debt draws or causing any equity dilution for you, the institutional partners.
Okay, on to Section 3, milestone-gated capital deployment. Let's look at the sequencing.
Let's move to and see how this builds across the timeline, physically locking in safety. Look at Phase 0. Capital exposure here is strictly limited to a 7.5 million rand risk profile prior to entitlement. Then, the major Phase 1 implementation draw of 85 million rand, that is called only after zoning is officially gazetted and legally locked down. So your institutional equity is completely walled off from the agricultural conversion and zoning risks.
In fact, the underwriting framework makes an incredibly bold statement on this, stating, and I quote, "The absolute maximum loss exposure is strictly limited to the R7.5M Phase 0 soft cost tranche, completely insulating the remaining R232.5M institutional equity stack." End quote. I mean, that is the definitive structural safety net. Zero major capital is at risk before entitlement is 100% confirmed by the tribunals.
Let's shift gears to Section 4, the Sovereign Microcity Moat. First off, we have to grasp the macro trend here. Stellenbosch alone is facing a 7,000-plus bed housing deficit. The demand is literally off the charts. But what makes this physical asset truly unassailable is its utility sovereignty. This estate packs a built-in 500-kilowatt solar microgrid. It boasts a 500,000-liter rainwater storage network with full on-site treatment and gray water recycling. Let me be clear. This isn't just some nice-to-have green amenity for marketing. It's a hardcore defensive moat, ensuring complete utility sovereignty and business continuity even during severe national municipal utility failures.
And this environment creates a brilliantly unassailable asset. We're looking at a thriving commercial hub with integrated transit on one hand and an unmatched sports and lifestyle precinct on the other. You know, the severe lack of secure housing in South Africa directly negatively impacts academic performance. By delivering an incredibly secure, supportive, and self-sufficient student experience, this estate directly solves a human capital crisis, forging a massive documented demand moat. Now get this. Here's a surprising fact that really highlights the sheer conservatism of this underwriting. The initial model projected almost 16 million rand in transient holiday rental revenue. But to satisfy the ultra-strict forensic due diligence standards for bank credit committees, they literally stripped that entirely from the model. The financial numbers we are looking at today assume absolutely zero speculative hospitality risk.
Which brings us to our final phase, Section 5, Priority Returns and Exit. So the crucial point is how this exit waterfall is structured to protect you. Step 1 prioritizes 100% of transfer proceeds to immediately repay your 240 million rand priority capital injection. Step 2 ensures you clear a 15% per annum compounded preferred return on any exposed capital. It's only in Step 3, the residual equity split, that the sponsor actually sees any back-end promote. And even then, investors keep a massive 65% share of the upside.
This structure drives an extremely strong annualized development IRR of 30.2% over a 10-year hold. And keep in mind, this isn't just some rosy forecast self-reported by the sponsor. This is fully backed by independent fiduciary oversight from Turner & Townsend, providing impartial project management and draw certifications to strictly prevent any internal fee conflicts.
What's more, even after that initial phase of unit sales, the SPV holds on to a retained portfolio of 350 beds. Take a second to absorb this. That retained portfolio generates a normalized Year 5 recurring EBITDA of over 22 million rand. Capitalized at a highly conservative 9.5% yield covenant, that establishes a bank-verified stabilized valuation of roughly 235.68 million rand. That heavily secures the long-term solvency of the vehicle.
So what does this all mean? Look closely at your current real estate allocations. Do they offer this level of forensically underwritten, mathematically solvent, and de-risked sovereign infrastructure? If you are an institutional allocator searching for bulletproof downside protection paired with a legally protected 65% back-end equity split, you absolutely need to request the full due diligence back for the Winelands student estate today. Thanks so much for joining me on this explainer, and as always, keep learning.